After making the initial video on the all-in-one loan, the biggest question that I got was, how does this loan stack up to a traditional mortgage? So to break things down and show you how much this loan can actually save you, let's jump into the simulator. Let's compare an all-in-one loan to a traditional 30-year mortgage. So I'm in our all-in-one loan simulator here. We're gonna start a new simulation. We're gonna set this up as a purchase. If you were wanting to look at a refinance, either cash out or rate and term, or even a construction loan, you certainly could. But for our purposes today, and to keep things super simple, we're just gonna look at a purchase loan. So we're gonna set this up as a primary residence, and we're gonna compare it to a traditional loan. I'm going to estimate that our sales price, or the property that our client is purchasing, is $600,000. If you had a specific property or knew the price point you were shopping at, you could input that here. And our client's going to put 20% down. We're going to compare it to a 30-year fixed rate loan, and we're going to assume that the average interest rate today is 6.75%. This is where you need to start being very, very particular with the numbers. So my client, we're going to assume that they make $120,000 annually. They're paid a salary, but I want to know what actually gets deposited into their account every single month. So they get paid biweekly, and that biweekly paycheck is $3,568.20. And if you had bonus or other earnings, you could factor that in here. Or if you knew, like, hey, I get an annual bonus of $25,000, tack it in. Or if you knew that you had maybe an inheritance coming down the line or some sort of big paycheck, you could factor that one-time deposit in here. But to keep things as clean and simple as possible, we're just going to look at base salary. So once I've got that, I'm going to hit the next button, and it takes us to our spending. Most people think of their spending as far as like, hey, I've got a credit card that has a $75 monthly payment, as well as a car loan of $300 a month, and they don't factor in everything else in their total monthly budget. So let's look at childcare expenses, utilities, car insurance, going out to eat, getting Starbucks once a week or once a day or whatever it is. Get really, really granular in the numbers, because it'll show you more accurate results and the power of how this loan actually works. So instead of using just a percentage left over, I like to go to option 2 and really dive into the numbers. So my client has some additional monthly expenses that total up to $1,875. And for this home, $600,000 price point, we're going to assume that property taxes are $495 a month and homeowners insurance is $120, which is going to give us $615 in additional housing expenses. So once I've got all that, we're going to calculate our results. And this is where the numbers get really awesome. So for this loan, if my client was to take out an all-in-one loan, same property, same scenario, they would pay this loan off in 12.1 years. Their total savings would be $357,000. If they were to get a traditional 30-year fixed rate loan, their total expense to purchase the property would be $1.12 million to buy a $600,000 home, which is nuts. The other thing I like to look at is the pay down summary. A lot of people get hung up on the interest rate for this loan because it is higher, and that is just the sticker rate. If you look at what the effective rate on this loan is, it's 3.363%. I don't know of any mortgage in this current rate environment that's at 3.3%. So this loan program, the way that it leverages your money to pay down this loan quicker and save you money and time. The all-in-one loan is not your traditional mortgage. It's designed to help people get out of debt quicker and reduce the amount of interest that you pay on a mortgage. So if you're interested in a loan that can not only reduce the amount of money it costs to own a home, as well as shorten the amount of time you have to make a mortgage payment, let's talk.